But it all has consequences, and I think we're about, well, we are starting to see the consequences of.
They call him the Oracle of Omaha for a reason. With his decades of investment prowess and uncanny knack for predicted market turns, Warren Buffett has sounded the alarm bells once again. This time, his eyes are set on the vast U.S. real estate market landscape. Buffett's insights suggest a looming turbulence, potentially driven by unchecked debts and overzealous investments. In this in-depth exploration, we'll navigate the undercurrents of Buffett's predictions, shedding light on the causes and potential aftermath of the forthcoming real estate upheaval. Hold on to your hats. We're about to embark on an eye-opening journey into the world of property predictions. The background: a debt-fueled real estate market. The past decade and a half has witnessed a seismic shift in the U.S. real estate sector, and much of it owes its trajectory to rock-bottom interest rates. This low-interest environment has not only thrown open the doors to vast borrowing opportunities, but has also sent property valuations skyrocketing to never-before-seen peaks. But as with any towering structure, its stability depends on the foundation it's built upon. To truly comprehend the gravity of Buffett's warning, we need to peel back the layers of a conventional commercial real estate venture. Let's dive deep and understand the moving parts of this complex machine. Navigating the tightrope of commercial property ventures. Picture this. An eager investor has their eyes set on a sprawling commercial asset, perhaps a sleek office space with a price tag of $1 million. Rarely does an investor possess such a hefty sum in liquid assets, so they strategize. They take the initial leap by pooling $350,000 of their own funds, termed equity. They approach a bank to bridge the financial gap, securing a loan for the outstanding $650,000. Now here's where things get intricate. The profitability, or the lifeblood of this venture, is deeply intertwined with the interest rate on this loan. Let's say the interest rate is 5% on an interest-only arrangement. That pegs the annual debt repayment at $32,500. All is well if the property consistently churns out enough revenue, the net operating income, or NOI, to effortlessly cover this financial obligation. But there's a twist in the tale. Unlike the steadfast nature of residential mortgages, commercial real estate loans are akin to shifting sands. Their interest rates don't remain static, but undergo recalibration every few years. This circumstance can spell turbulent waters for the property's custodian when coupled with a substantial hike in interest rates during the loan's tenure. As Robert G. Allen wisely noted, the best investment on earth is earth. But with fluctuating interest rates, even the sturdiest of investments can feel like quicksand under one's feet.
So there are ways to be a passive investor in real estate at first, but even if you're actively involved and own it all yourself, eventually you'll own enough of them that you'll hire somebody else to do the job you don't want to do anymore. You don't want to paint kitchens. You don't want to fix toilets. You don't want to do any of that. You don't want to mow lawns. I'm sorry, don't want to do that. The goal is to ultimately be a passive investor.
The domino effect, how interest rates can topple real estate investments. Before we dive into the domino effects of interest rates, take a moment to smash that like button, subscribe for more deep dives like this, and remember to ring that notification bell to stay ahead of the curve. Now let's uncover the intricacies of interest rates and their impact. Warren Buffett's prescient warning takes aim at the ever-menacing shadow of soaring interest rates on commercial properties. To decipher the magnitude of this impending debacle, let's engage in a hypothetical exploration. Picture a grand property, a symbol of architectural marvel, acquired for a cool $1 million, backed by a loan of $650,000 at an agreeable 5% interest rate. The annual financial obligation is a manageable $32,500. The property's steady revenue stream, the net operating income, or NOI, stands robustly at $60,000, ensuring the investor can navigate any minor financial turbulence. However, as the tides of the economy change, so do interest rates. Let's embark on a journey where these rates decide to climb. 7% interest rate. Suddenly, the annual debt obligation experiences a leap, rising to $45,500. With the property's income still secure at $60,000, it's a challenge, but not a catastrophe for the investor. 9% interest rate. Here's where the terrain becomes treacherous. The debt commitment escalates to an intimidating $58,500. Let's add a twist. The property's income takes a hit, dwindling to $40,000. The glittering hallways may see fewer footsteps due to shifts in work patterns, with remote work gaining traction. Now the investor's once fruitful venture seems on the brink of peril. In such a grim landscape, foreclosure's cold hand could soon knock on the door, with the property's revenue insufficient to combat the rising debt tide. As famed economist Paul Samuelson remarked, investing should be more like watching paint dry or watching grass grow. If you want excitement, take $800 and go to Las Vegas. And with spiraling interest rates, the once stable world of real estate can quickly transform into a high-stakes gamble. The double-edged sword of non-recourse loans. In commercial real estate, an essential, though sometimes misunderstood element called non-recourse debt lurks. It may seem like a protective shield for the investor, but it's crucial to understand its broader implications. Here's the central tenet of non-recourse loans. These aren't your standard loans where borrowers are personally bound to repay the borrowed amount. In the unpredictable world of commercial real estate, these loans offer a seemingly comforting promise. If, for any reason, the property slips into foreclosure, the borrower has the liberty to relinquish the property without any further monetary obligations. Sounds ideal, right? However, there's more to the story. This very feature that offers solace can also lay the foundation for potential pitfalls. In his classic wisdom, Warren Buffett once stated, "Risk comes from not knowing what you're doing." In the context of non-recourse loans, the seductive lure of that no personal liability can sometimes obscure the broader ramifications on the market. Without the tether of personal responsibility, some investors might venture more recklessly into ambitious projects, banking on the safety net of non-recourse loans. This attitude could inflate property values and contribute to an unstable market landscape. The scenario is eerily reminiscent of the days leading up to past financial crises, a bubble swelling under the weight of overconfidence and unchecked lending practices. Grasping the gravity, a $1.4 trillion domino effect. When we zoom out to appreciate the broader financial picture, the sheer scale of the looming crisis seems palpable. A colossal $1.4 trillion. That's the astronomical amount of commercial real estate loans teetering on the edge, slated to mature in 12 to 24 months. These aren't just any loans. These are commitments made during a golden era of rock-bottom interest rates when the allure of skyrocketing property valuations swayed investors. For a more vivid visualization, consider this. $1.4 trillion is more than the entire GDP of Spain or Australia. That is the magnitude of this potential economic impact we're discussing. But these aren't just abstract numbers on a balance sheet. We're already witnessing the beginnings of this financial unraveling in the real estate sphere. Take, for instance, the shocking case of Starwood. Starwood, a giant in the real estate investment landscape, recently faced financial strain when they defaulted on a hefty $212 million loan tied to an office property in Atlanta. The once prized asset had seen its value nosedive. The shift in dynamics made it more financially prudent for Starwood to hand over the keys to the lender rather than engage in a potentially futile renegotiation. Benjamin Franklin once remarked, "By failing to prepare, you are preparing to fail." These early warning signs, like the Starwood default, underscore the urgent need for both investors and the broader market to brace themselves. As the ripples of these tremors spread, they hold the potential to reshape the landscape of commercial real estate investment. The consequences beyond real estate. The tremors of this impending crisis aren't confined within the glittering skyscrapers and mega office complexes. Its shockwaves promise to reverberate far and wide, touching corners of the economy many might consider insulated from the world of commercial real estate. At the core of this intricate web are the unsung heroes of the American banking system, small regional and community banks. While they might lack the towering presence of Wall Street's behemoths, They're deeply interwoven into the fabric of Main Street. These modest-sized institutions are the chief financiers for the small and medium-sized enterprises, or SMEs, that pepper our communities. From the charming cafe on the corner to the family-run hardware store down the lane, SMEs rely heavily on these banks, often dubbed the backbone of America. Now imagine a scenario where these banks, overwhelmed by the financial fallout from soaring real estate loans, have their hands tied. Their once fluid flow of funds could slow down to a trickle, directly impacting their ability to extend credit to SMEs. A reduced lending capability can starve these businesses of essential capital needed for operations, expansions, and most crucially, employment.
Most people like to buy with non-recourse in real estate. And one time I asked Charlie, there was some real estate guy we were talking to him, and how do they decide how much a building like this is worth? And the answer is it's whatever they can borrow without signing their name.
Renowned economist John Maynard Keynes once observed, when the capital development of a country becomes a byproduct of the activities of a casino, the job is likely to be ill done. In our current scenario, as these banks grapple with the repercussions of high-stakes real estate gambles, the everyday entrepreneur, the worker, and the local community stand to bear the brunt. While the storm's epicenter may lie in lofty boardrooms and property portfolios, its cascading effects threaten to touch the heart of our neighborhoods. Understanding this interconnectedness is critical to appreciating the full spectrum of this impending crisis. Heeding the warning bells, from real estate to Main Street. As the investing legend Warren Buffett often reminds us, it's only when the tide goes out that you learn who's been swimming naked. The current scenario paints a sobering picture of a real estate market that may be caught in a vulnerable state as the tides of economic change rush in. The looming storm, characterized by the merging forces of increasing interest rates and the quirks of non-recourse debt, doesn't just signify a tempest for commercial real estate magnates. Its undercurrents can pull the unassuming bystanders of our society, the small businesses and the common folk, into its whirlpool. Remember, the intricate interconnectedness of the modern financial system means the ripples in one sector can lead to waves in another. Buffett's warning, arising from his decades of economic wisdom, isn't just a forecast for real estate professionals, but a clarion call for us to be prudent, aware, and prepared. If you found this analysis enlightening, please do us a favor. Like this video, subscribe for more insights, and share it with others to spread the knowledge. Together, we can navigate the complexities of our financial world, equipped with the correct information.